One of the reasons why so many investors are talking about Serve Robotics is because it's an AI company and AI companies are incredibly popular right now. But another reason is the company's performance improvements expectations. In the most recent quarter, it only generated like 200,000 in revenue, but the company is expected to explode to a revenue run rate closer to $60 million by the end of next year. And so that explosion, that upcoming explosion in growth, has a lot of investors discussing Serve Robotics stock. So let's look at the details and how it plans to do that and the progress so far.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
As I mentioned, in the latest quarter, they delivered 222,000 in revenue, and delivery and branding specifically contributed 183,000, with growth of 49% from the previous quarter and 108% from the same quarter last year. So they're already demonstrating increasing levels of growth. The company had 59 daily active robots in the latest quarter. That was a 23% increase from the previous quarter, 97% increase from the same time last year. So these active robots produced an average of 465 daily supply hours, which was a 21% increase from the previous quarter and 108% increase from the prior year. As of right now, they're only operating in the Los Angeles area. I live in the Los Angeles area, and I see these robots all the time, all over the place, and they're always on the move. They are getting increasingly more popular. I'm seeing them more and more often. And so I can see firsthand the growth in the business and the growth in the effectiveness of these products. Let's say 6 months ago when I was seeing these, they were stopped more often than not. They would get discombobulated when there would be people walking around, when there was movement, car movement, cars changing lanes, cars, turning in front of them when they were about to cross the street. And so they would get discombobulated. Recently, I've been seeing their performances a lot better. They react better to those disturbances. They know how to react to those situations, and the performance is improving. So just, my firsthand anecdotal experience with these robots, seeing them around here in the Los Angeles area. So they anticipate recognizing a few $100,000 of additional revenue in the first half of 2025 from their software sales, licensing their robotics technology. Those are high margin revenues, but that's a small part of the overall business plan, which I'll talk more about a little later. Their year-over-year basis, delivery and branding gross margins improved by 84% compared to the same time last year. And the company talked about several of the reasons for that, in one of which is just improvements in the technology. They're able to deliver better technology in these robots. Their latest generation, third generation robots are more capable, and they're able to produce them at a lower cost. So they're getting improvements on both sides of the equation real quickly. Still, they're losing a ton of money on the bottom line compared to revenue because they're still in expansion mode, still in research and development mode. The net loss in the third quarter came in at $8 million compared to revenue of just 222,000. So you can understand most of this spending is going to research and development and readying itself to have over roughly 2,000 robots early or by the end of next year. And that's going to add roughly 10x to their current fleet. And so that's how they're planning to expand to a much larger revenue total next year. But for the third quarter, their free cash flow was negative 10.1 million, and it included 7 million related to manufacturing costs to produce some of those 2,000 robots they expect next year. So to fund those losses, they are selling shares of stock, and they raised $32 million in the quarter by selling shares of stock, convertible basis. Otherwise, they're going to need to continue doing this, to continue raising capital, because they're not going to be break even for a long time. But if they continue hitting these milestones, which they're ahead of schedule on, it's going to make it easier for them to raise more capital because they can demonstrate progress to investors and show them look at how far we've come with the amount of money you've given us. If you give us a little more money, we can get to the next point, which will then be so much closer to the point where we're going to be a self-sustaining business. So they say that they have the $51 million in cash in the bank, and they think it's going to be enough to support their 2,000 robot rollout in 2025. So they're not going to need any more money to do this task. And if this task is completed as is planned and they're ahead of schedule on this, and they have these 2,000 robots on the roads operating, on the sidewalks, I should say, operating, then that will be easier for them to go back to investors and say, all right, you funded us to this point. We got 2,000 robots on the road. We're well on our way to generating tens of millions of dollars in revenue. Now it's time to give us more money to expand into more cities, expand into more states, expand into new categories, whereby we expect our revenues to explode even further. So they don't need any capital immediately, but they are open to that possibility if, let's say their stock price explodes by 10x or something like that. They say they'll take the opportunity to raise more money, but they don't need to. And that's a great position to be in, where you don't need to raise money yet, but if you find an opportunity, you can do so. So this is the big thing here. This is one of the main reasons investors are excited about and talking about Serve Robotics, is they're saying that their financial outlook continues to project a run rate of 60 million to 80 million in annualized revenue once the robots are deployed and reach full utilization. So then they go on to say that the majority of those 2,000 robots related to their Uber contract. Of course, they're big partners with Uber. Uber is a strategic partner, and it makes sense, right? Uber is big in food delivery. And they say that this will happen in the second half of 2025. So that means that they're planning to be at this annualized run rate by the second half of 2025. So let's say in the fourth quarter of next year, they plan to generate at least $15 million in revenue. That's a big jump from the $222,000 they just generated in Q3 2024. So that's what investors are excited about and looking forward to. And of course, the company is saying they expect their revenue to be weighted towards the latter half of the year. Now you're saying, wait a minute, they said 60 million and you're telling me 15 million. Well, what they're saying is annualized revenue run rate. That means that they're going to get to a place where in one quarter, they're going to generate enough revenue that if you annualize it, will lead to 60 to 80 million. So that means that if you look at the fourth quarter specifically, they plan to have roughly $15 million in revenue at least, because if you annualize 15 million for a quarter, you multiply it by 4, that gets you to 60 million. So that's why I say at least 15 million is what they're hoping, is what they're planning for, and what they're shooting for that time. And if they hit that target, man, investors are going to be excited about this company. And I suspect that will create a lift in the stock price, of course, depending on how much money they have to spend to get to that point and what their losses will be at that revenue run rate. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.